This is ALBrooks, and this is my price action trading course. This module is on swinging and scalping. A swing trade, it's any trade where the reward is at least twice as big as the risk. It's as simple as that. Anytime you're going for a reward that's twice as big as your risk, I consider it a swing. If you go for a trade where the reward is less than twice the risk, I call it a scalp. In general, with a swing trade, traders are expecting at least two legs in their direction. So if they're buying for a swing up, they're expecting at least two legs, maybe many more legs, but at least two. For a scalp, you're usually just looking for one quick leg. So for example, if there's a bull spike and then a pullback and then you're buying for a scalp, you're just buying for one more push up. Even though the market may go much further, you're buying just for a quick scalp, a quick move. In general, scalping looks extremely easy to do, but it's extremely difficult to do profitably, and beginners should not be looking to scalp. Beginners should be looking for swing trades. I have a section, a module later on that talks about what beginners should do and how to trade, how to start out. Here's an example. If your stop is 20 ticks away from your entry price, then the risk is 20 ticks. If you're going for a reward that's 40 ticks or more, the trade's a swing. If you're going for a reward that's less than 40 ticks, the trade is a scalp. As I said, scalpers are just looking for a quick move. They usually don't allow pullbacks, or they'll only allow very small pullbacks. Swing traders will allow one pullback beyond their entry price, but if the trend resumes in their direction, they'll have a break-even stop and they will not let the market come back to their entry price a second time. And in general, they're looking for at least two legs. Okay, here we have a possible higher high major trend reversal, or a possible trading range top. A swing trader, if he's shorted here, taking this second entry high, the second entry short at the high, he would allow the market to come back to his entry price here. However, once the market started down again, he would place his stop at break even, and he would exit if the market came back to his entry price a second time. A scalper on this trade in the E-mini had to risk a total of 5 ticks, 1 tick above the signal bar for his stop, 1 tick below for his entry price, so he might get out at a 5-tick profit. Again, beginners should swing rather than scalp, and when scalping, if an experienced trader is scalping, in general it's far better to be scalping with in the direction of the trend. If you have a very broad bull channel, for example, a very weak trend, you can scalp in both directions. Beginners, however, they should never scalp against a weak trend. So if the market's in a weak bull channel, beginners should only, if they're looking to scalp, they should only be taking the buy signals and not the sell signals. When there's a pretty strong trend, traders should not be scalping. Trends are always trying to reverse. But almost all reversals end up as flags in the direction of the trend. So here we have a bear trend, and we have lots of great reversal bars. Here's a bull reversal bar. Here are a pair of bull bars closing on their high. Here is a 2-bar reversal after an II final flag. None of these trades was a profitable scalp. Here's the price scale on the right. All right. If you're going for a reward at least as big as your risk or twice as big as your risk, it's virtually impossible to make money scalping when the market is fairly strongly down. So here the channel is pretty tight going down. Not big swings, so traders should not be looking to buy. Every one of these reversal attempts, as good as they looked at the time they formed, they became simply bear flags, failing at the moving average and leading to another leg down. This is what you should be doing when you see a bear trend. Even a channel with some swings up. you should concentrate on taking the shorts. So every time it gets up to near the moving average, you look to go short below bear bars. So all of these scalps were profitable, whereas very few of the buy scalps were profitable. So beginners for sure should only take the shorts. As soon as they diagnose the market as being in a bear trend, here it's a bear trend and it's a bear channel, so it's a relatively weak trend, you still should only trade in the direction of the trend, which means looking to short. Beginners love to scalp against the trend. They believe that the correction is overdue and that the trend can't go much further, and they're so afraid of losing that they only consider risk in the trader's equation, right? And trader's equation has three variables: probability, risk, and reward. All they do is see that they're, for example, in that bear trend, all they see is that they're buying above a small bull signal bar, and their risk is small. It's only to the bottom side of the bar. However, they're ignoring the reality that the probability is low and that the reward is also too small in the face of that low probability to make a profit, and they'll slowly watch their account melt away. Again, a terrible trader's equation. When the probability is small and each loss is greater than each winner, you'll bleed to death from 1,000 paper cuts. So yes, each loss will be small, and you'll say, well, I'm not losing all that much. But if you keep losing, and losing, those small losses add up to a lot. Small risk, tight stop for a scalp, all right? You need a high probability trade. This is the key to scalping. If you're going for a small reward, let's say reward equal to your risk or twice as big as your risk, okay, you need a high probability trade to be profitable. Can scalping be profitable? Sure it can be. High frequency trading firms scalp all the time, and a lot of them make money. Not all of them, a lot of them lose money, but a lot of them make money. What's the easiest way to make money trading scalps? First of all, selectively picking out the very best trades and using big volume, or as big as you possibly can use. However, the reality is when you're taking those best trades, most of them end up being swings, so you'd make more money by swinging rather than scalping. So if you have the ability to spot those best trades, why scalp them? Just go ahead and swing them. Okay, at the other extreme, impossible for most traders, instead of swinging, is extreme scalping. All right, you can see the module on extreme scalping. High frequency trading firms, they're scalpers, and they're using computers to generate the signals, and they're taking thousands of trades a day, going for very small profits. And because the computers are making the trades and making the decisions, they don't get tired, and they take every signal exactly according to plan. So they can have a relatively low probability, let's say 55% probability, maybe a risk as big as their reward, and if they do it thousands of times a day and do it exactly correctly every time, they can make money. However, it's extremely difficult for humans to do that when the margin of error is so small. Also, high-frequency trading firms have minimum commissions. Okay, when you're talking about risk, there are two important types of risk to consider. There's the initial risk, the distance of your initial protective stop, and then there's the actual risk, right? So the initial risk is the distance to your original stop, from your entry price to the stop. Your actual risk is once the trade starts to go your way, you look back to see how many ticks the market went against you before it went your direction. Your actual risk was one tick more than that number. In other words, let's say you short and the market pulls back a little bit after you enter and then it turns down again. For you to not have been stopped out, you can look back and calculate how many ticks the market went against you, and had your stop been one tick more than that, you would not have been stopped out. that is your actual risk. And you can use your actual risk for determining what your profit target should be. So you can convert a swing trade into a scalp trade. Okay, most swing trades have low probability, but if the market starts to go your way and you discover that your actual risk is very small, you can convert some of your swing to a scalp and still have a sound mathematical equation, trader's equation. But you got to make sure that if you do go for a scalp, a small reward, that your reward is at least as big as your risk. Okay, going back to what I was saying on how to calculate actual risk, this is what you do. You count the number of ticks that the market moved against you before it went your way. So once the market starts to go your way again, you look at how many ticks the market went against you, and one tick more than that was your actual risk. So you can reduce your target to your actual risk, and you can convert some or all of your swing into a scalp and have a positive trader's equation. So here's an example. If traders bought this higher low major trend reversal, a bear trend, trend line break, small higher low, if they bought this going for a swing and they entered and the market went up pretty quickly, they could look back and say, my actual risk was one tick below the low of this bar, my actual risk is small, 4 ticks, therefore I can scalp out with 4 ticks. If they took it for a swing, their swing stop, their initial risk was below the bottom of this spike, maybe below the actual bottom of the trend, more likely below the bottom of the spike. So when they bought here for a swing, they initially put their stop down here. However, once the market started to turn up, they discovered that their actual risk was just 1 tick below their entry bar or 1 tick below the signal bar, and it was small. So they could take out part or all of their trade as a scalp. And that's the end of my module on swinging and scalping.